Let's move to the markets now. As speaking of big reactions, we have a monster rally off of that softer CPI, with a lot of the beaten down stocks up sharply today. Names like Enphase and even Paramount. Meanwhile, the semi ETF at a new all-time high today. So too is the broader tech ETF, the XLK. My next guest is buying into the momentum trade and has been since August. After he forecasted the S&P would near 5,000, he still expects this bullish trend to continue through year-end without much pullback in sight. Andrew Slimmon is back with us. He's senior portfolio manager at Morgan Stanley Investment Management. Andrew, welcome. And I wanted to play up the bearishness that our previous guest at UBS had about the economy so that you can come in and explain how long these two things can exist side by side. Stocks rallying on this relief about the Fed and inflation, but still with larger concerns about the cycle persisting.
Sure. Well, the key thing here, Kelly, is that the CPI print has pushed rates lower. And at 446 on the 10-year, that will mean the stock market can trade at a higher multiple. And combine that with the fact that earnings have come through. And as we roll into next year, we're going to start next year with an earnings consensus S&P estimate of close to 250. That's why the market's rallying. It's the lower rates where bonds are less of a competitor to stocks, and that pushes the valuation higher. I
want to quote from our Robert Hum's note and a lot of LSEG data as we move through earnings season, where they say the record earnings we were expecting in Q4, we got them in Q3. That's a good thing. The problem is that for 6 weeks straight, Q4 earnings growth expectations have been revised down by about 5 points, so a pretty significant way. And we expect declines in Q4, even in Q1, so we don't get back to where we were in Q3 until the second quarter of next year. Is that supportive enough for stocks?
I think so, because even with modestly lower earnings for next year, we're still looking at 11% earnings growth coming off a flat year. So we're inflecting, and that was one of my key reasons why I felt we'd have a fourth quarter rally, is the market starts to recognize after a flat year-over-year earnings year, we're going to have inflecting to positive earnings growth next year. And I still think that's the case. Companies are not guiding lower for next year. And so that's very, very positive for earnings recovery. And that is a key reason why, I felt that we'd have a fourth quarter rally.
Yeah. And how much does your conviction extend beyond that?
Well, I mean, what I think when the dust settles on this year next, this year is going to be, for the S&P, a very good year. And I suspect next year will be a positive year, but it won't be nearly as good, because the key difference is we started this year, Kelly, and we talked about this before, with so many bears. Most strategists were negative going into this year. The boat everyone was on one side of the boat, very bearish. And I suspect as we begin next year, the level of enthusiasm will be higher for stocks, so the path will be a little tougher. I still think it'll be a good year, but it won't be nearly as good as this year. I certainly felt like kind of a dope a few weeks ago when the market was at 4,100, but I feel a little bit more redeemed today.
Yeah, and the bears, by the way, have been in the same boat at different junctures. And that actually brings me to my next question, which is, we still haven't taken out the highs from the end of 2021 for the S&P, which was around 4,800, correct me if I'm wrong. What does that tell you that for the last 2 years now, basically, we've gone nowhere?
Well, a friend of mine uses a great analogy, which is it's like a beach ball held underwater. Eventually, it breaks to the upside. And I think this is a very important metric to understand, Kelly, because when I talk to clients and advisors, they still say to me, my clients are not positive on stocks because they're still below where they were 2 years ago in terms of their total asset value. So I don't think optimism actually is going to get ebullient until we break above that high. But the point of this is 2 years of staying low. The market's not going to break to the downside. Eventually, it will break to the upside. That's just the way it happens.